In August 2026, Washington finalized a funding package, allocating over $2 billion for critical mining and related projects. That was alongside more than $180 million directed specifically toward mining education.
Right, and if you look at the immediate market reaction, the assumption there was fairly straightforward that the United States simply required more domestic extraction.
But the actual allocation of that capital points to a much harder structural problem. That funding reached battery anodes, permanent magnets, scandium, graphite, tantalum, niobium, boron, and of course rare earth development.
Along with the precise workforce training needed to operate those specific midstream facilities.
Which is the core issue here. The allocation reveals where the actual bottleneck sits. A country can own the deposit, secure the extraction rights, and still remain entirely dependent on a foreign entity for the material its domestic factories actually consume.
That is what we call the illusion of extraction. I mean, rare earth ore is not a motor magnet, lithium-bearing rock is not a battery chemical, copper concentrate is not a transformer winding.
The strategic leverage simply does not accumulate at the mine site. It sits entirely in the middle. In separation, refining, purification, metallurgy, qualification, and final component production.
Because owning the deposit does not equal sovereignty. Between the initial extraction and the final manufacturing, you have a highly complex chemical and engineering chain.
If we look at the International Energy Agency's 2026 assessment data, the reality of that processing concentration is quite stark.
The concentration remains extremely high across the board. The IEA data shows China leading most major energy minerals, while Indonesia leads in nickel.
We did observe modest diversification in rare earth refining, mostly supported by new capacity coming online in the United States and Malaysia.
Well, yes, but the broader processing system remains heavily concentrated. Opening a domestic mine simply moves the dependency one step downstream if the processing is still offshored.
If graphite still requires foreign purification or rare earth oxide still depends on another nation for metal and magnet production, the structural vulnerability has not been solved.
To understand exactly where these shortages are modeled, we should transition from geographic concentration to the specific project pipelines.
The IEA estimates for 2035 illustrate this processing gap quite clearly. Existing and announced rare earth refining capacity in geographically diverse regions will equal only about 2/3 of the expected mined output.
And as you move further downstream, the constraint becomes even tighter. Planned permanent magnet capacity is only about 1/3 of the projected mine supply.
The battery materials sector mirrors this exact bottleneck, doesn't it?
It does. Planned cathode capacity in diversified regions equals only about 1/3 of the projected lithium mining capacity.
This highlights a crucial disconnect in how the broader market views the supply chain. The mining phase is frankly a ribbon-cutting photo op. You break ground, you move earth, and you generate a highly visible product.
Processing, on the other hand, is an invisible multi-year engineering trial.
If you are an automaker evaluating a new domestic rare earth mine, you cannot simply sign a purchase order and shift your magnet supply away from legacy overseas providers just because a new deposit has entered commercial production.
No. The switching costs are immense. The friction in the midstream revolves entirely around qualification. The refined material must meet extreme purity and performance specifications.
An automaker or an electronics manufacturer is not going to risk their final product on an unproven supplier.
Exactly. The production yields must hold steady. The processed material has to be tested in real manufacturing lines at industrial volume.
It is not a stamp of approval you earn overnight. The supplier must prove they can maintain exact chemical tolerances across millions of units.
And that rigorous qualification process creates a massive structural moat around the established ecosystem. You are competing against legacy operations that possess trained metallurgists, specialized equipment suppliers,
Deeply ingrained process knowledge.
right, and established downstream customers. This is not a market you can enter simply by possessing the raw commodity on a balance sheet.
If the middle of the supply chain is clearly the bottleneck, the logical question for an institutional investor is why private capital isn't aggressively building out that capacity.
Well, the answer lies in the capital expenditure reality. Look at the IEA cost estimates. They present a brutal landscape for new entrants.
New refining projects located outside the dominant supplier face capital costs that are 20% to more than 150% higher.
Furthermore, the operating costs for these new facilities average roughly 50% higher. Commodity markets reward cost and scale. They do not reward geopolitical usefulness.
A strategically important processing facility can still be a highly uncompetitive business.
The open market prioritizes low unit costs and reliable yield. When a new entrant carries 50% higher operating costs, they are immediately positioned at the most vulnerable end of the cost curve.
You can see private capital adjusting to this reality in the 2025 investment cycle data. Critical mineral investment actually fell by about 9%.
Battery metal spending dropped by more than 20%.
And capital expenditure by companies focused specifically on lithium dropped by roughly 40%. But then you look at copper, and the trend moves in the opposite direction.
Spending by copper-focused companies rose by about 8%.
How should capital allocators interpret this divergence in the data?
The divergence is driven by supply modeling. Lithium is currently navigating oversupply, whereas copper is attracting new capital expenditure because the future deficit is structural.
Based on the IEA's assumptions, the projected copper supply deficit in 2035 remains around 25%.
So the takeaway for capital allocators is that the best geological asset is not automatically the best business.
Depending on the specific market, the truly scarce asset changes. For one mineral, the scarce asset might be the mine itself.
For a different mineral, the scarcity sits in the separation capacity, the smelter, or simply a customer willing to sign a firm 10-year purchase commitment.
That distinction is why public finance is stepping in. Private capital demands returns. Governments demand resilience.
A private corporation evaluating a secondary supply chain pathway still has to generate a financial return on that specific asset.
Advanced economies recognize this gap in bankability. In 2025, public finance commitments for critical minerals reached approximately $65 billion.
That is more than 4 times the level observed in 2023.
The tools deployed include equity investments, concessional loans, guarantees, strategic reserves, price protection, and long-term offtakes.
We have to evaluate how those specific tools alter the financial structure of a project. The 2025 United States Agreement with MP Materials serves as the primary blueprint for how industrial policy is shifting into project finance.
That MP Materials blueprint established a 10-year price floor of $110 per kilogram for neodymium praseodymium products.
It also included long-term structural support for the output of a new magnet facility.
For someone analyzing this from a traditional equities perspective, how does a structured price floor differ mechanically from a standard government subsidy?
It directly targets project bankability. When lenders evaluate a billion-dollar processing facility, they ask one question: who buys the output when global prices inevitably fall?
A standard subsidy might provide a one-time cash injection or a tax credit, but it leaves the facility exposed to foreign dumping or cyclical price crashes.
The tools you listed solve specific weaknesses. An offtake agreement reduces volume risk by guaranteeing a buyer.
A price floor, like the $110 per kilogram for NdPr, reduces downside price risk.
And a loan guarantee lowers the cost of capital.
But none of those financial instruments can turn an inefficient plant into an efficient one, which brings us to the security premium.
If diversified Western supply structurally costs more to produce, are taxpayers and manufacturers effectively subsidizing permanent inefficiency?
You have to look at the margin squeeze math modeled by the IEA to understand where that inefficiency is absorbed. Let us examine the final product economics.
Critical minerals account for roughly 25% of total battery cell costs.
But when you move to the final consumer product, those minerals represent only about 3% of the price of an average electric vehicle.
The math regarding rare earths is even more extreme. Rare earths make up approximately 40% of the costs for a permanent magnet.
Yet, they account for less than 1% of a vehicle's total overall value.
The IEA modeling illustrates that even if rare earth prices were to triple, it would add only about 0.1% to the final manufacturing cost of a car.
This creates a unique financial dynamic. The midstream processor absorbs the entirety of the price volatility.
It functions like a localized pressure valve or an hourglass.
The giant mining operations at the top of the supply chain manage their margins. The massive downstream automakers at the bottom barely see a ripple in their final sticker price.
But the processors sitting in the narrow neck of the hourglass get completely crushed by a margin squeeze.
If the government does not absorb the security premium and the automaker refuses to pay above the spot price, the newly built processing plant simply goes bankrupt.
This points directly to the threat of overbuilding. Governments funding multiple plants in the pursuit of supply security run the risk of market oversaturation.
The 2025 IEA smelter utilization data highlights this risk clearly. Utilization rates for smelters outside of China fell below 70%.
Meanwhile, utilization for facilities inside China remained steady at around 85%.
In industrial processing, scale and utilization dictate survival. The mathematics of a death spiral are straightforward. A facility has massive fixed costs.
If utilization falls below 70%, you are dividing those fixed costs across fewer kilograms of output. That mechanically raises your unit
And
costs,
that higher unit cost drives away commercial buyers, who migrate back to the cheaper legacy suppliers.
which leads to lost orders. Those lost orders push the utilization rate down even further, raising the unit cost again,
The facility enters a death spiral.
which means industrial resilience cannot be measured by the raw number of facilities a government announces or funds. A funded plant with a 60% utilization rate is just a stranded asset waiting to happen.
The risks of holding stranded midstream assets are not theoretical, especially as demand vectors expand and global supply chains remain weaponized.
We saw the physical reality of this during recent geopolitical stress testing. China's 2025 export controls targeted 7 heavy rare earth elements.
The resulting shortages forced automakers outside of China to either reduce their utilization rates or halt production lines altogether.
Look at the IEA stress scenario, which models the full implementation of broader rare earth restrictions. It puts approximately $6.5 trillion a year of downstream production outside China at severe risk.
That figure demonstrates the massive leverage of processing. A major manufacturing facility can have abundant labor, secure semiconductors, adequate steel, and billions in customer orders.
Yet it can lose its entire output because one highly specific low-volume material is unavailable.
And while geopolitical friction is stressing the supply side, the physical infrastructure build-out for artificial intelligence is massively pulling on the demand side.
Well, the infrastructure required for AI is entirely physical. Data centers require massive grid connections, advanced liquid cooling systems, transformers, and extensive electrical equipment.
Copper is directly tied into that structural build-out.
Alongside copper, semiconductors and advanced electronics are driving demand for smaller strategic minerals like gallium, germanium, indium, and antimony.
A material like gallium or germanium can represent a negligible fraction of total global tonnage. But if it is completely unavailable, it will halt a massive production line.
When disruptions carry a multi-trillion-dollar risk, governments naturally look toward strategic stockpiles as a mitigation tool.
This brings us to Project Vault. In 2026, the U.S. Export-Import Bank approved a direct loan of up to $10 billion for a strategic reserve. The rationale is to inject inventory into the system when global trade is disrupted.
But you have to sharply differentiate between holding inventory and possessing capability. A stockpile merely buys time.
It acts as an insurance policy against immediate shocks, but relying solely on reserves create a false sense of security.
A $10 billion stockpile cannot train a metallurgist. It cannot improve a complex chemical separation yield.
It cannot qualify a new graphite supplier with an automaker, and it certainly cannot construct and calibrate a new magnet plant after a severe shortage has already commenced.
It is a bridge, but it is not a destination.
Which means investors and policymakers must define what strategic success and strategic failure actually look like in this sector. Success occurs when public financing removes just enough of the early-stage risk to get a competitive project built.
Industrial customers sign long-term contracts. The plant achieves high utilization rates.
The engineering team steadily improve production yields, and over time, the security premium gradually falls because the newly established system becomes inherently more efficient.
But the failure matrix is much more common. A processing facility comes online late and significantly over budget. Broader commodity prices soften.
The commercial customers return to their lower-cost legacy suppliers. The facility's utilization rate drops below viability.
The project then requires continuous government intervention, is forced to restructure its debt, takes a massive impairment, or ceases operations entirely.
The physical plant exists, but the ecosystem never reaches commercial sustainability. This establishes a clear institutional dashboard for anyone allocating capital in this space.
Watching the aggregate dollar amount of government funding is insufficient.
You must monitor processing yield, you must track facility utilization, you must verify customer qualification.
You must analyze exactly where the plant sits on the global cost curve, and you must evaluate the length and pricing mechanics of their offtake contracts.
If we look at the strategic verdict on this sector, where does the ultimate leverage reside?
The strongest winners will not be companies with the largest geological resource estimates. The durable winners will be processors with repeatable quality. equipment suppliers with difficult-to-replicate tech, and integrated producers with committed industrial buyers. Policy can absorb initial risk, but it cannot repeal the fundamental cost curve.
For the next documentary, tell us which model you think is most durable: price protection, long-term industrial offtakes, or strategic stockpiles. Subscribe to the Unlayered Global for documentaries that follow money, technology, industrial capacity, and corporate power through the systems shaping the global economy. Because mineral sovereignty is not achieved when a country owns the rock. It is achieved when its factories no longer depend on someone else to make the rock usable.